Webinar Wednesday. Today we're going to be talking about how you can sell your Amazon business, how you can get an exit. I'm Megla in Singapore and I'm joined by Margaret and Kevin in Australia. Hi Mark, Kevin, how are you guys doing?
Very well this morning.
Nice
Hi
and cold?
Megla. Yeah, it is a bit brisk today. Yeah, it's a bit brisk for a week,
the sun's
or
out.
more. Yeah.
It looks nice.
But it is our winter, so it was highly expected.
Cool. And we are in our India sourcing t-shirts. I don't think people can see it, but
I'll have to stand up.
We'll stand up.
Yeah,
there you go, look.
there we are. There we go.
Get mine down. Yeah.
How cool is that? Okay, so our guest Adrian Johnston is waiting backstage, but before we invite him on stage, there are a couple of things that we wanted to talk about. First of all, our PPC workshop is ongoing and there's still time to join in. We've done one session last week, and so if you sign up now, then you'll be able to get the recording of the previous session as well as all of the resources that were shared after the first session. And then you can join us live for the second session, which is going to be held Friday evening in the US, Saturday morning if you are in Asia or Australia. So this is a very, very comprehensive workshop that covers all the basics of Amazon PPC, including how to set up campaigns and what is the best way to find keywords, how to differentiate between long tail, short tail, and exact match and phrase match and all of those things that are very complicated sometimes to newbies. And most importantly, things like how to optimize your campaign so that you can have a lower ACoS and you can get more sales from the money that you're spending on PPC. So very, very highly recommend joining this workshop. In fact, Ritu has been, she spoke at the Prosper show. She gave a couple of presentations there. Then she was also on the Lunch with Norm show yesterday. Was it yesterday? Yeah. So
I think, yeah.
Yeah, yesterday, yeah. Yeah, I joined up just to be in the Telegram group, Megla.
Yeah, exactly. The Telegram group is on fire. There's just, that's one big advantage of joining any of our workshops. We have a Telegram group dedicated to each workshop. So if you have any questions after the workshop, you can come into the Telegram group and the workshop conductor, in this case Ritu, they're in the Telegram group. They'll be able to answer any questions that you might have. So you have like immediate access to these experts. So definitely check out the PPC workshop. And then Margaret, do you want to?
Yeah, because I checked the Telegram. I'm sorry. I was just going to quickly say I checked the Telegram group, and some of the questions in it are just amazing. And the banter, even the banter between the people in the group. So I think on the whole, everybody just enjoys the camaraderie as well as the the learning process. So it's good to see.
Yeah, absolutely.
Yeah. Look, I'd just like to touch again on our payment service provider we've put into our group, Airwallex. Those of you who haven't seen us talk about it before, I don't know where you've been, but we have talked about it quite a bit. But look, there's been a few people with samples still not knowing how to pay for samples. So look, I think the best thing is if you open an Airwallex account, you can actually pay for your samples out of your US dollar account. They will actually pay for it in IRN. So it's really a no-brainer. There's probably any fees. The fees are really low to do that. Transfers of your Amazon payments are within 24 hours of your close. When you pay on Amazon email, you usually get the payment just after 24 hours from that. So that's really good. And look, I think just the whole conversion rate is amazing. I always check anytime I bring anything back from the US or do any transactions, how much I've actually got compared to the rate. And I find Yahoo Finance and Airwallex are virtually parallel. I mean, if you're doing it through PayPal or something, you're probably getting horrific amount of money. In fact, I checked a couple of things doing my books for the end of the financial year, and I was paying. I couldn't believe how much money I lost last year by paying things not using Airwallex because the conversion rate was horrific. I mean, I was getting, like, the Helium 10 was $97 and it was costing me 160 Australian dollars, which is just criminal. So I think they're the things that you need to look at. So yeah, anybody, it's on the screen now. If you are in doubt or wanting to pay for samples and things, it's a great way. And they've got some good deals there shown on the screen. If you're first $20,000 of transactions is fee free. Not $20,000 free, just the fees. Okay, so on with the show, Megla.
Yeah, I've started using Airwallex as well for all of my transactions, and I just love it. I actually enjoy banking now, because previously when I was using my regular bank or other service providers, I used to be like, oh my God, I have to do a transaction, I have to go online, and it was a pain. But I actually enjoy using Airwallex. The interface
it's very
is
easy to use. Yeah,
very easy to use, very user friendly as well. Yeah. So someone is saying, good morning, MMK, but we don't know who you are. If you want to quickly go into this link, streamyard.com/Facebook, give StreamYard access to your profile. We'll be able to see your name on the screen. Okay, so let's get started with the show. And I am going to invite our guest, Adrian Johnston. Hi, Adrian. How are you?
Hi, everyone. I'm very good, thanks.
Good morning, Adrian.
Great to see you all. How are you guys doing?
Good morning,
Doing
Adrian.
great.
Very well. Yourself?
Excellent. Yeah, wonderful. Yeah.
Yeah, you've got a beautiful backdrop there. That's a real window behind you, right? Not a Zoom screen.
No, it's real. Don't worry. We've got Bear Park down there.
Yeah. Awesome. That's a beautiful
no,
view.
lovely.
Cool. So, Adrian, we're excited to talk about how to exit an Amazon brand, and we've got a couple of questions for you. But before that, do you want to tell us a little bit about yourself, your background, and how you ended up with Una Brands?
Yes, of course. Yes, I'm Adrian. I'm the co-founder of Una Brands. I'm originally from the UK, from near London, a place called Guildford. But I've been in Australia for about a year now. Una Brands, we launched at the beginning of the year. We are the only FBA aggregator which is based in Australia. And since launching, we've already acquired a very large portfolio of brands, both in Australia and also outside Australia, across the region. In terms of a little bit about my background, I started my career in London in investment banking, and then I moved into management consulting at Boston Consulting Group with a focus on e-commerce. So I spent the last 5 years working on that, both in London and in Australia. And then through that, I kind of became interested in the kind of aggregator model, and then launched Una Brands at the beginning of the year. So
awesome, very impressive. So guys watching, if you have any questions for Adrian, definitely type them in the comments, and Adrian will be taking questions as well. So Adrian, first of all, what do you think is the state of overall FBA acquisitions, in Australia and also globally?
Yeah, sure. So the FBA acquisition market is on fire at the moment. I don't know whether you guys have seen the kind of action in this space, but it really is a space that's picking up. And I guess there's always been a market for acquisition in this space, but I guess what's different now is that it's attracted the interest of kind of institutional investors, both in the private equity and the kind of venture capital space. And that's certainly true for Una Brands. So Una Brands, in March, we launched our seed round of funding, where we acquired 50 million Aussie dollars worth of capital to invest in this space. That was one of the largest ever seed rounds of funding in the region, and we're looking to kind of deploy that capital over the course of the next, before the end of the year, really. And we're just going through kind of a Series A now. And so the question is, why is there so much interest in this space at the moment? And there's a few different factors behind it, really. I guess the first and most obvious factor is the behavioral shift that was kind of caused by the pandemic last year, driving a lot of people online, many for the first time in a big way, in the way that they shop. And that created, for many people, kind of the highest revenue years that they've ever seen in their stores. And with that increased revenue and profitability in the space, that kind of has driven a fair amount of interest from an acquisitions perspective. But then I think there's also a few other factors at play. One is is around what in the private equity world is called the dry powder. So currently in the private equity space, there is basically a wall of capital waiting to be deployed in the space, and that's there not only deployed in the e-commerce space, but generally. And the reason that's there is a whole bunch of historical factors, including kind of low interest rates and various other factors. And so that's kind of ready to be deployed, and this is a space that kind of people haven't really looked at before. And then I think a third reason is that people were kind of waiting to see how this business model of kind of acquiring e-commerce players turned out, and this was first done, I guess, kind of 18 months ago, and people were, I guess, waiting to see what the outcome of that was. I guess it's proved successful, and people have now seen that this is a very successful business model, and so with that kind of proof point, investors are now kind of lower risk investors are now more happy to invest in e-commerce businesses. And so when you put all of those three factors together, it's created a market where it's definitely a seller's market, I would say, at the moment. Unclear how long that's going to last. Some people getting nervous around whether that's going to last for a long time, but certainly at the moment, you would definitely describe this as being a kind of seller's market from an acquisitions perspective.
That's great. Yeah. No, well, I think there'd be a lot of people out there thinking, oh, can I sell? So can you tell us actually how an FBA business is valued?
Yeah, of course. So there's two components that go into the valuation of an FBA business. Firstly, there's the profitability, and then the multiple. And different people use different calculation methodologies for these. But if you take the annual profitability, so let's suppose you had a business that was turning over, say, $200,000, and you had a multiple of, say, 2.5 times the profit, then the valuation would be, say, $500,000. And so how are these two components made up? Well, when we talk about the profitability, the metric that we use is a metric called SDE, which is the seller's discretionary earning. And the seller's discretionary earning is basically the bottom line profitability, but you don't remove from your revenue the seller's salary. So let's suppose you were to turn over $1 million. Let's suppose that you were to have a bottom line profitability of 200K. If you were to have paid yourself a salary of 50K for that year, then you would add that back in. So the SDE, the seller's discretionary earning, would be 250K rather than the 200K. We look at what's called the TTM SDE, which stands for the trading 12-month SDE. If it's a very, very high growth business, then we might also look at the annualized 6-month profitability to give credit for the fact that the business has grown quite a lot. So that's one piece of the puzzle, and then the second piece of the puzzle is, what do you multiply that profit by, which is the multiple, and we have kind of an internal proprietary scorecard which we use to come up with a multiple for the business. And that scorecard looks into a whole bunch of different factors. It looks at how many SKUs does the business have. Typically, the lower the better, because the lower the complexity. What's the current ROAS of the business? How many years has it been in operation? Typically, we look for businesses over 6 to 12 months old. What's the profit margin? How does it perform in terms of external marketing from Google, Facebook? And so there's about 20 or 30 different characteristics that we look for, and we put them all together, and it comes out with a multiple number, which we then kind of sense check, obviously, and put our own spin on, and then that gives you the valuation.
That's quite complex.
Yeah, there are a lot of different factors. Yeah.
Is Kevin frozen?
Okay. I think he might be.
Kevin, are you there? Can you hear us?
No, he's back.
Oh, yeah, he's back, but he's muted.
You back? Oh, I think he's gone. No, I think he's frozen. Do you want to do the next one, Megla?
Yeah, so Yeah, definitely. So, what exactly is the typical multiple for an Amazon business from your perspective, or yeah?
Yeah, sure. So the multiples have increased a little bit over the past year. I think one benchmark, which is a pretty good benchmark, is the Empire Flippers annual report, and the 2021 annual report put that number at 2.9 times the trailing 12-month profitability. That's actually a 13% increase on 2020. So when I say it's kind of a seller's market at the moment, what I'm referring to is the multiples at the moment are kind of at historically high levels, and they've never been kind of this high. And not only that, the deal volume has also increased. So the Empire Flippers report reported a 66% increase in volume compared to last year of deals, with the average deal size increasing 73% and the average days on the market decreasing to 43 days, which is a 16% decrease. So in terms of the multiple, yeah, you'd be looking between 2 and 3 times the profitability of the business. Typically, the larger the business, the higher the multiple. So if you have a business that has a profitability of in the 1 or 2 or 3 million range, then you'd be looking at potentially even a 3.2 times the annual profit as a multiple. If it has a profitability of like 100 or 200k, then you might be more down at the 2 range.
Interesting.
Yeah, no. So look, if I've been spending a lot of money on sort of advertising, Google, Facebook and that, what effect does that have? Do you take that into account, that I might have spent a lot of money over the previous 6 months in marketing, or does that not come into it? Does that just get lost in the profit?
So that's a great question. It partially depends on, the advertising does get taken out of the profits, the advertising spend, but that only the spend that you spend on the actual adverts themselves. If you're using like a third party to manage your adverts, then actually that doesn't, in our calculation, that does not get taken out of the profitability. If you've had a big outlay on advertising because of a product launch, then typically we would make an adjustment for that, because the ongoing advertising spend you would expect to be lower than the launch spend. And then the other thing to bear in mind is that if you've put a lot of money into developing a product, for example, that would also not get taken out of the profitability calculation, as I said. Yeah. So anything to do with product development or like photography or anything like that, yeah, that isn't counted as part of the long run profitability of the business that we look at.
Okay.
Interesting.
Yeah.
Kev, you're back.
Yeah, sorry about that, guys. I've don't know what it is. Just to check. Maybe because the kids have gone back to school today.
yeah. We've had nobody working from home. Oh, everyone working from home until today.
The internet is alive with kids learning.
Yeah. Cool. So, I guess another question is, how do sellers prepare their business for sale?
Yeah, sure. It's a good question. There's a whole bunch of things that people can do to prepare their business. Some of them are pretty simple, like making sure your business has separate business accounts. It sounds like a very simple thing to do, but you'd be surprised with the number of businesses that we value where you're trying to pull apart different expenses and what proportion of the postage was for this business versus this business, and all of these types of things, which can make it quite frustrating. So definitely kind of making sure the hygiene of the business, as we call it, is up to scratch with separate accounts and all the rest of it. I think secondly, it's definitely worth investing in third-party tools to calculate your profit and to provide you a dashboard of the business. In particular, Xero or one of the others, I would say, is critical in terms of from an accounting perspective. Again, a lot of businesses still don't use even simple software like Xero. On top of Xero, though, we would recommend that people use A2X or something similar to match the invoices versus the Amazon sales, or things like Sellerboard or Zonguru are very helpful in terms of the P&L calculations as well. In addition to those tools, I would say there's a few other things as well. One thing that we say to people is kind of trim the fat of the business, as it were. And a lot of people will, and this is quite often where there can be misconception as well, because a lot of people will think, if I'm going to sell my business, I need to launch into all these marketplaces and, try and launch on these other platforms and have all these products and all the rest of it. Actually, the more complex a business, the less attractive it is to us. And quite often, launching into new Amazon marketplaces, unless it's done correctly, quite often doesn't have a material impact on the revenue, but it does add a lot more complexity to the business. And so we would say to people, unless you're going to do something, properly and really well, we would hold off from spreading yourselves too thin across loads of products and loads of marketplaces. The other thing with that as well is that if we look at a business which is in the US and hasn't touched the European market, for example, to us that provides a huge opportunity for growth. Whereas if it's a business that's in the US that's dabbled a bit in the European market, not had very much success, then we kind of look at that and think, maybe the European option isn't that attractive for this business. So it's businesses with lots of room to grow are very attractive for us. And then
what are some of the key things that makes a business? Oh, sorry, mate.
I just wanted to say one thing. Like, if at the moment the hot topic is everyone's joining Walmart, so you would say if someone's looking at selling in the next 12 months, don't sign up to Walmart, don't do all that. Wait, is that what you're sort of referring there, or?
Yeah, that's right. I mean, so with the businesses that we've acquired, we're also looking to bring them onto Walmart. It's a huge opportunity. I think they're adding 5,000 sellers a week or something. Was a statistic I read recently. And so, Walmart will be a huge player in the future. I'd say it's fine to go down that route if you're going to do it properly, as it were. But dipping your toes into lots of different things is less useful, I'd say. Yeah.
Okay, thanks. Yep. Go, Kev.
Yeah, sorry. So what are some of the key things that you think makes a business more valuable, Adrian?
Yeah, sure. So we touched on some of these things, but as I was saying, the size of the business, typically larger businesses trade for higher multiples. The fewer the SKUs, the more valuable, because it's typically a simpler business. If a business has less than 15 SKUs, that's kind of perfect for us. Anything more than kind of 50 or 80 becomes probably slightly too much for what we're looking for. In terms of the businesses that we look for, we have certain criterias. So we look for businesses that have revenue of greater than about 500,000 Aussie dollars per year. We don't really have an upper limit, but typically when you get beyond about 10 million Aussie dollars, then those businesses will have taken external funding and will typically not be the types of businesses that we would look to acquire. In terms of categories, we focus very much on kind of safe categories of home and living. So kitchen, outdoor, pets, baby, bathroom, sports, those types of categories. We stay away from things like electronics. Electronics we stay away from because for two reasons. One, the return rate is pretty high, and two, the development cycle is quite intense and quite complex. Products go out of fashion and out of need to be updated relatively frequently, but also the R&D that needs to be put into that is higher than for other categories. We stay away from fashion just because the return rates are through the roof, and keeping up with a 6 monthly fashion cycle is a pretty complex thing to do. And then we also stay away from things like supplements, just because of the regulatory uncertainty around supplements and those such things. So yeah, those are the businesses that are attractive to us from an acquisition perspective.
Let's take this question from Mohammed. So he's asking, what about a brand has 20 SKUs where 10 are very profitable and another 10 are not really profitable? Will Una Brands acquire the whole SKUs or all of the SKUs or just the profitable ones? And how do you handle the situation?
Yeah, sure. We'll definitely buy the whole business. But just a word of warning on that is that our valuation methodology is measured on the profitability. So if you have some SKUs that have zero profit, then essentially they'll be counted for quite relatively low valuation increase. The only time where that might be different is if there's very clear, very high potential for one or two of those SKUs, then we might attribute some valuation to that. But otherwise, they wouldn't really feature into the valuation.
Okay.
Mark, do you want to go next?
Yeah, look, how do you actually value the inventory that people have? Like, is it better to fill up your inventory and have it all on order and things, or to hold it back and have nothing? Like, what do you want?
Yeah, sure. This is a question that comes up a lot actually, because people, think, I've just had a big outlay on inventory. That feels a bit unfair. The way that we do this is that we pay for the inventory, what we call the excess inventory, on top of the acquisition, and we calculate what we call the operating inventory, the amount of inventory that's required to run the business on a day-to-day basis, and then any inventory that you have on hand, in addition to the operating inventory, we will pay for on top at the time of closing. And the kind of analogy that we use is kind of, if you were to buy a torch, and you need 3 batteries to run the torch, you would probably want the 3 batteries to come with the torch. But if the torch came with an extra 20 batteries, which means that you weren't going to have to buy batteries for the next year or whatever, then you'd be very happy to pay for those additional 20 batteries on top of the base purchase price. So that's kind of how we look at it. And actually, we encourage people to stock up on inventory prior to acquisition, and during the kind of DD process, we encourage people to do that, to make sure that we don't buy a business that then runs out of stock kind of immediately after acquisition.
Right. Kev, do you want to go next?
Yeah. So how does the size of the my business affect the multiple and the selling process?
Yeah, sure. So as I said, we buy businesses that have a revenue of greater than about 500,000 Aussie dollars. There are other acquirers who will typically have a much higher revenue threshold. So the US acquirers will typically only buy businesses that have more than $5 million in revenue, with a profitability of above kind of $1 or $2 million. So we are kind of unique in that sense, that we acquire smaller businesses as well as the larger businesses. In terms of how it affects the multiple, so smaller businesses will typically have a lower multiple than larger businesses. In terms of the valuation methodology, other than that, there's not a huge amount of difference. Yep.
Thank you.
So here's a question from Mohammed. How do you take the brand to a higher level once acquired? And is non-AU entity considered for acquisition as well?
Mohammed, your second great question. So I'll answer the second question first. We buy businesses that are based in Australia and APAC, but typically actually the marketplace of sale is not local. So typically we buy FBA businesses that are selling to the US, buying from China and selling to the US. And so some of those businesses have set up kind of LLCs in the US. Some of them haven't. Both of those are totally fine. Some people choose to set up in locations like Hong Kong or Singapore. That's also totally fine from our perspective. The location of the entity is, we're totally agnostic to that. And then the first question around how do we grow the business after acquisition? So this is kind of really what we bring to the table. And one of the pieces of the acquisition, which we'll talk about later, is the profit share. But people like to know that if they're going to be receiving a profit share, they want to know that we're actually going to be able to grow their business. And so we invest a huge amount in growing the business. Firstly, just in terms of working capital to purchase stock and grow from that perspective. But then outside of that, there are kind of 3 or 4 levers that we look to pull on. The first is geographical expansion. So businesses that are selling to the US, we would look to expand immediately to Canada or Mexico, although those typically tend to be relatively small uplifts. Next to Europe, in particular the UK, because there's no language barrier, also Australia. And then after that to markets in Europe, Germany and France and Spain. The second lever we pull is channel expansion. And as we discussed earlier, Walmart is a big play in the US at the moment. In Australia, you're talking about eBay, Catch, Kogan. In APAC, you're talking about Lazada, Shopee, and other kind of local national players. And then outside of the marketplaces, one big trend at the moment is taking products onto Shopify, and this isn't appropriate for all brands. Typically, if it's kind of a staple product, the Shopify route is not such an attractive route. But if it's a very kind of unique, highly branded product that you can build a community around, then Shopify or kind of WooCommerce or the other ones is actually a really great way of going. And the reason why is that quite often people will use Facebook or Google adverts to send customers to Amazon, whereas if you can send them directly to your website, then you capture all of their information, and you reduce the fees that you're paying. In order to do that, though, typically we would recommend people set up with a 3PL that is able to provide kind of pick and pack services. Quite often people will drip feed from their 3PL into Amazon, and it's pretty useful if that 3PL you're using for the drip feed also is able to provide individual pick and pack services. Then that enables the expansion to these other platforms much more easily. And the other big trend at the moment, or the other big thing that people are talking about, is seller fulfilled prime, or SFP, where if you've proven yourself to be an effective seller over a period of time, then Amazon will allow you to become prime, even if you're just doing FBM. And I think that's going to be a big trend in the coming years, given how tight the inventory space is on Amazon at the moment.
Yeah. Are you finding a lot of FBM kind of services in Asia? Because there are a lot of 3PLs in the US and in Europe and all, but I find that there's not that many over here. I mean, especially in Singapore, there are so many sellers, for example, from outside of Singapore who want to sell on Amazon Singapore, but they find it very difficult to really find a reliable 3PL that can actually fulfill their orders. So
yeah, it's certainly more of a nascent market compared to some of the providers in the US. That said, the gap is being filled very quickly. There are a number of players who kind of 3PL providers, and 4PL providers are also entering the space as well. In Singapore,
What's
there are
fourth PL.
So the 4PL. So 3PL is when you own your own warehouse, and then you have a whole bunch of different companies' inventory in your warehouse, and they fulfill all of them. The 4PLs are where they don't even own their own warehouse. They are in contact with like 4 or 5 other warehouses, and they just manage the relationship between the warehouse and the seller. And so, me as a seller, I wouldn't interact with the warehouse at all. I would just interact with this 4PL, and the 4PL would distribute my stock amongst multiple different warehouses, and they would manage that relationship as well. And there's another one which is called 5PL, which is where everything is done. I won't even go into that.
Yeah, maybe that's an opportunity for Una Brands to launch a service that does that.
Yeah.
Cool.
So
yeah, go ahead, Mark.
yeah, no, you go. Off you go.
No, I was just going to ask, like, how does wholesale affect my business valuation? We talked a lot about all the different types of marketplaces and Shopify and everything, but what if somebody does wholesale?
Yeah, so we are a little bit unique in the acquisition space in that we will acquire businesses that have a small proportion of wholesale sales. Typically, we prefer businesses not to have more than 20 or 30% of their sales through the wholesale channel. The reason why, I guess, is that if you're selling on marketplaces kind of directly to consumers, if you have a large proportion of wholesale, then you can come under price pressure from, like, you have less control over where all of your stock is distributed, and the relationship management piece for a wholesaler is much more intense because you have to manage these individual relationships with the distributors, whereas with kind of selling through a platform or selling through Shopify, you don't have such a direct relationship with the end consumer that you need to manage on an ongoing basis, and so that makes it a more scalable business.
Right. Mohammed is saying next year we will have 10 PM.
Yeah, exactly.
When you're looking at a business and you start with the due diligence, what do you actually look for when you start looking at that process?
Yeah, sure. So maybe I'll just run you through the whole kind of pipeline and how it works. So the first thing that we will do, so after signing an NDA with a seller, is that we will do a very quick what we call a sprint due diligence, which takes typically about a week to complete. And we will look at the kind of high level profitability of the business, and do some analysis around the market, very outside in analysis. And we will then come back to the seller with a valuation for the business. If the seller agrees to the valuation, then we sign what's called the term sheet or the letter of intent, which lays out the broad terms of the deal. We then enter into a 3 or 4 week period for the detailed due diligence phase. And the detailed due diligence is broken into 3 parts. There's the financial due diligence, the legal due diligence, and the operational due diligence. And so when I'm talking about the financial due diligence, we'll ask for bank statements for the past 2 years. We'll ask for view access to Xero, or whichever accounting software you're using. We'll look through any annual reports that you've submitted to the government, as well as matching off any of the COGS data that you've provided us with the actual PIs that you've received from the sellers, from the suppliers. In terms of the legal due diligence, this is the piece that typically takes the longest, because this is where we draft the legal agreement, which is called the asset purchase agreement or the share purchase agreement, depending on the structure of the deal. And this process goes backwards and forwards. So the seller would hire a lawyer. We have our own lawyers, and the document would go back and forwards between us maximum 2 times. The document that we use is a very standard, streamlined document, so there isn't usually too many problems here, but it does require input from everybody. And then also in the legal DD phase, we'll also look at any trademark registrations, any patent registrations, and just kind of double check everything on that side of things. And then we enter the operational due diligence. This is the last stage, which we leave till later in the due diligence phase. Here we will speak to all of the suppliers, and kind of just get a sense for what the handover process will look like post acquisition, to make sure that everybody feels comfortable with what's happening and aligned on how that process will work. So that's the kind of 3 stages of the due diligence. We also have a proprietary check that we do for kind of black hat techniques and those types of things as well, which we obviously filter out.
Don't encourage that for sure.
Yeah.
And then what is the process after the price has been agreed, or did you cover that?
Well, I can. I think I've covered that kind of process there. The seller is very involved with all of the conversations that we have with the suppliers. Sometimes this is a area which causes concern because people have built up relationships with their suppliers over a long period of time, and so people want to know that that's going to be managed correctly. I guess one piece I didn't touch off in that explanation is just how the deal is typically structured, and this forms part of the term sheet or the letter of intent. And so the way the deal is typically structured is that there is 3 or 4 components to the deal. There's the base purchase price, which is paid on day one of the transaction. Then you have what's called the stability payment. The stability payment is usually kind of 15 or 20% of the base purchase price, and the stability payment is paid out typically 1 year after completion, on condition that the business, quote unquote, has remained stable. And what we mean by that is that the revenue is either the same or more. The annual revenue is either the same or more after 12 months after completion as it was at the date of signing. Then you have what's called the profit share, or some people call it the earn-out. And the earn-out is typically a percentage of any increased profitability for a defined period of time. So you can kind of think of this as being like a royalty payment for use of the brand, essentially. And then you have the inventory payment, which is agreed up front. And then you might also have a consulting agreement. And we are very keen for the sellers to remain engaged with us as consultants. It's not mandatory, and some sellers will say to us, will say to us, "I'm going to go on a round the world tour and speak to me in 6 months," type thing.
Spend all my money.
Yeah. And we're happy to facilitate that, and we've done that in the past. But typically, actually, sellers are interested to stay involved in their business, and so that might look like a kind of 1 day a week kind of consulting agreement, or whatever the seller is comfortable with. And the type of tasks that the seller will usually stay involved with is usually around the kind of product development side of things, because we in-house we have a whole bunch of expertise around inventory management and operations and supply chain, but where the seller really has deep expertise is around the product and the needs of the customer in that product segment, because the seller has kind of lived and breathed this product for typically 3 or 4 years or whatever, and has really got to know the ins and outs. And so it'd be kind of crazy for us to lose all of that knowledge. So we love the seller to stay involved to help with product development and other things. And typically, to be honest, that's the area that the sellers enjoy most anyway. Quite often people will say to us, I started this because I love building a brand and I love satisfying the customer needs and developing products. But now that the business has grown to the size it has, I find most of my time dedicated to inventory, wondering whether the ship is going to arrive in the port, or logging onto my account every single morning and checking every single SKU to make sure that Amazon hasn't taken it down. Whereas we have a whole team of people, that's all they do and they love it. So fine for people to leave all of that side of stuff up to us, and then you just get involved in kind of the fun bit, as it were, which is the product development.
Now, Adrian, if you get through and you get like a successful sale and it's all organised, how does it actually migrate? Do you sort of wake up one day like you're selling a house and move out and the other people move in? Or how do you actually transfer the stock and like the company? Or do you actually take the company, or do you take the brand? How does all that bit work?
So typically we'll buy
the seller has 2 brands under an account, right? How does that work? And they only want to sell one brand.
Yep, if they only want to sell one brand, we can do that using an ASIN transfer rather than a seller central account transfer. That's not our preferred method, though. We do typically prefer to acquire the seller central account as well, because typically it comes with positive reviews and all the rest of it. but yeah, if people only want to sell one brand, we can do that. If people have two brands that are quite different as well, we're happy to lump those together and make an offer for both brands at once. We've done that in the past as well. But in terms of how we transfer the accounts, so we factor in a kind of 3-month integration period. Typically, it's done much quicker than that, but there are pieces of the puzzle that can take a little bit longer. The first thing that happens is the transfer of the seller central account, and this is a bit of a technical process. We've developed a kind of streamlined methodology around this. There is sometimes a concern, doing anything on Amazon, that Amazon might, you might get flagged as doing something unusual, and then they shut down the account, all the rest of it. Amazon is very, very trigger happy when it comes to this type of thing. So we've developed a process to avoid all of that. It's a very robust process, but it still typically does take 3 or 4 days to transfer the account smoothly. There's kind of 3 pieces that need to be transferred. There's the bank account, the company name, and then the username and password. And we typically spread those out to make sure that there's no issues there. As soon as the seller central account has been transferred, we take a stock take, and the stock take then becomes the benchmark that we measure, that we pay the excess inventory from. We then, after that moment, all the liabilities of the business then pass over to Unibrands. So we then pay for any new stock that is purchased, or any 3PL costs or anything like that going forward, we then pay for. But then obviously also we then, from that point forward, also receive any payments from Amazon into our bank account as well. So that's the kind of the nuts and bolts of it. The part that typically takes a while to transfer over is the supplier relationship, and the way that we do that is quite gradual. So we'll start by having ourselves added onto the various chats that people have with their suppliers, and the various email chains, or WeChat or Skype or whatever, and then after a week or 2, we might start to be the ones writing to the suppliers with the sellers there in the background, keeping the kind of continuity. And then after a little while, then that whole thing will transfer over to us. But where the seller is interested, the seller is able to remain in the background of all of all of the chats and even the seller central account. So yeah, typically the seller will have full kind of pretty much admin access to the seller central account for many months afterwards, if they choose to. And actually, one of the big reasons why people say that they're keen to sell is because they think, they'd love to launch a new brand, and people are keen to get some new ideas, I guess, from the way that we operate the brands, and then potentially implement those new ideas in their future businesses that they want to run. And we're very happy to kind of do a kind of knowledge transfer and help people in that way.
Yeah. So Andrew Simmons has, I guess it's just a comment, or maybe there's another part of this. Maybe it's a question and it hasn't come through. Andrew, can you just clarify? But he's saying an example might be a trademarked Amazon brand registered brand with design products and FBA, an established supply chain, and a US 3PL able to fulfill orders with only short sales history. So, not sure if there's a question over there.
I guess the question might be, how established does the business need to be? Typically, we look for businesses that have been in operation for more than about 6 months. If there are exceptional circumstances why then we can consider newer businesses than that. What you mentioned about the brand registry, that's very attractive to us, we would expect all businesses selling on Amazon.com to have brand registry. obviously without brand registry, you then lose control of the listing, or you can lose control of the listing.
Yeah.
So it's very, very important to us.
Yeah. So I guess what Andrew is saying is this is an ideal kind of situation for you guys where, it's brand registered, it's got an established supply chain and a US 3PL fulfilling all of the orders, etc.
Yeah.
Cool. So guys, any more questions for Adrian before we start signing off over here? Let us know if you have any questions. Type them in the chat. We'll be here for another couple of minutes. So Adrian, of course, you guys must be frantically hiring now because you've got all of these businesses and now you have to, set up teams in place to manage all of the different things. So as you are starting to manage these businesses, what are some of the things that you're seeing that are, more challenging? What are the sort of more challenging pieces of running an Amazon business or an e-commerce business?
I mean, there are a couple of trends that are affecting, I guess, everybody and not just us. One is the increase in PPC costs, which I think increased 20% month on month in the month of April, which certainly impacted some of our brands, and I'm sure for some of your listeners as well. The second big thing is the shipping costs. Which kind of went through the roof since the beginning of the year.
Yeah.
Obviously, everybody's hoping that those will come back down, but that's where it's really important to I guess, have a high profit margin which can absorb some of the fluctuations and variability there. And then one big announcement from Amazon last week is that they will now rebate 10% of the sale price for sales which come through external advertising from Facebook and Google, and so this is a bit of a game changer. And there's a bit of a worry in my mind how long this is going to last. It's likely to be one of those kind of sweetener deals where everybody ramps up all of their Facebook and Google advertising, sending traffic to Amazon, and then maybe 6 months later they reduce to 5%, and then they cut the whole thing off altogether. Which could be a concern, but certainly for the next little period, we're going to be taking full advantage of that. I would say, yeah. Yeah,
we got one question from Jason. What are some typical shareholding options, if any?
So for us, we only buy 100% of the businesses that we acquire. But the profit share that I described earlier does typically act very similar to and in fact it gives you more certainty than having a share in the business, because when we define the profit share, we have a very strict definition of how the profitability is calculated, which can't be manipulated, and so that hopefully gives confidence to sellers in the way that they're going to participate from the brand's growth going forward.
Sense. Mark, any more questions?
No, I don't think. I think we've got, well, I mean, it sounds really exciting, and I'm sure there's a lot of people out there thinking, wow, I can look at selling down the track. And I think, like we keep harping on about get your trademark, and I keep saying to people, none of the, sort of buyers out there are going to want to buy your business if you haven't got a trademark. So I think, you've just confirmed what we've been harping on.
Yeah. Very true.
What about sourcing products from different countries? Like we focus on sourcing from India, right? So, I mean, do you consider that a differentiation? Because most people are sourcing from China, but if you do get a brand that's, sourcing from India or any other country, would that be a consideration for you?
Yeah, certainly. And from our perspective, as you said, most people are sourcing from China, which actually presents quite a lot of concentration risk for us. So we certainly look very favorably on brands that are sourcing from outside of China, and India is a great place to source for sure. So yeah, that definitely puts people, to the front of the queue, as it were.
Yeah, I'm sure there'll be a lot of people in our group who will be interested in this. Maybe not now, but down the line. Okay, another question from Jason. Does Una Brands have a track record of any brands that have grown post-acquisition?
Yeah, certainly. So one of the first brands we acquired was a business called Cadams, which makes kind of digital clocks and timers. Margaret's very familiar with this business as well. But since acquisition, we've had a huge amount of success with the business. By the way, we only acquired it a few months ago, and the TTM, the trailing 12-month profitability, has increased 20% since then, and that's down to a few different factors. We launched a new color variation on one of the SKUs. We negotiated a price discount with our PPC provider, kind of third-party PPC experts. We have changed the warehousing to enable FBM. We launched a Shopify website from which we will also fulfill. So a whole bunch of levers that we're pulling there, and we haven't even started with the kind of geographical expansion yet. So a huge amount of more room there to grow. But yeah, exciting stuff so far. So yeah, that's the typical things that we look to do kind of pretty much immediately.
So let's take one last question from Michelle Canfer. Would you be able to share the range for the multiples? Most aggregators focus on larger businesses. Una is interesting. Thanks for sharing. And you have talked about this in the past, but maybe she joined later on. But do you want to just talk about the multiples real quick?
Yeah, sure. So I think the average multiple being paid at the moment, as per the Empire Flippers report, is kind of 2.9 times the annual profitability, the annual SDE, which doesn't include the seller's salary. And so, yeah, our multiples are kind of in that range as well.
And then you also mentioned bigger businesses tend to have higher multiples as compared to smaller businesses, right?
That's right. Yeah. So it can range from anywhere from 2.5-ish to 3.5, I would say.
And I guess our other question is, most aggregators focus on larger businesses, but you're not necessarily focused on like very large businesses, right? I mean, $500,000 per year revenue, that's what you're sort of looking at a minimum.
Yeah, that's exactly right. Yeah. So very keen to hear from anybody, and my email is on the screen there. It's adrian@una-brands.com. That's UNA-brands.com. And yeah, we're growing very rapidly, as you said. We're looking to acquire another kind of 10 businesses before the end of the year in Australia, and then another kind of 30 or 40 the year after. So very keen to hear from anybody interested in selling their brand.
Awesome. Well, Adrian, thank you so much for your time today. Really interesting to learn about Una, and wish you all the very best. I'm sure there'll be some people in the audience who will reach out to you, get in touch, and have some conversations.
Amazing. Thanks so much, guys. Really great to speak to you.
Thanks, Adrian.
Great.
Okay,
Thanks,
bye.
Cheers,
all right.
Bye. Thanks a lot, everybody, for joining us today. And we will see you next week for another Webinar Wednesday. Bye.
Okay, bye.